Good morning. I'm Gary DeWaal, and this is Bridging the Week for November 12th through 16th, and today is November 19th, 2018. Last week, the Commodity Futures Trading Commission's Division of Enforcement issued its annual report in which it said the purpose of its enforcement program was to engender a, quote, true culture of compliance, end of quote. The division suggested the measure of success for such culture would be evidenced by the chief executive officer of a company threatening new employees during orientation that the company itself would advise the CFTC, Department of Justice, or the Federal Bureau of Investigation if they ever violated the law. Separately, the SEC fined two companies for engaging in initial coin offerings without registration or relying on a bona fide exemption. The SEC obligated the companies, and they agreed, to pay back initial investors, upon request, the value of their ICO purchases, as well as to file registration statements for their digital tokens. The SEC said these settlements offered a path forward for other companies previously involved in ICOs. This coming week includes Thanksgiving in the United States. It's a week we all can reflect upon our own good fortunes and take constructive action to help alleviate the suffering of less fortunate. So I can hurry through this blog and other work-related tasks in order to do my part. Let's get started. In its annual report for the 2018 fiscal year, the Commodity Futures Trading Commission's Division of Enforcement said that the ultimate goal of its enforcement program is to engender in market participants, quote, a true culture of compliance, end of quote. The division said this would be accomplished when, standing before new hires, the chief executive officer warned that if they violated internal control regimes, not only would they have problems with internal company departments, including compliance, but with the CFTC and perhaps the Division of Justice, the Department of Justice, and the FBI. Why? Because, warned the CEO, quote, the company is committed to identifying any misconduct and to reporting it out to relevant authorities, end of quote. In its annual report, the division noted four of its priorities: preserving market integrity, protecting customers, promoting individual accountability, and augmenting cooperation with other regulators and criminal authorities. To accomplish these objectives, the division said it began or continued a number of quote-unquote key initiatives during fiscal year 2018, evolving its program of cooperation and self-reporting, enhancing data analytics, and creating specialized task forces to address spoofing and manipulative trading, virtual currency, insider trading and protection of confidential information, and obligations to file suspicious activity reports and maintain Know Your Customer programs for anti-money laundering purposes. Consistent with its objectives, the division observed that it filed 83 new actions in fiscal year 2018, including 30 involving retail fraud, 26 pertaining to manipulative conduct, false reporting, and spoofing, and 11 where illegal off-exchange contracts or failure to register was alleged. The division indicated that more than two-thirds of enforcement actions named one or more individuals, including primary wrongdoers and aiders and abettors. Named individuals included supervisors, desk heads, chief executive officers, and a chairman of the board. Although it may not rise to the level of John Gresham's current bestseller, The Reckoning, the CFTC's Division of Enforcement's fiscal year 2018 annual report is compelling reading. It is concise, well-drafted, and punchy, and it clearly expounds the objectives of the Division's enforcement program, whether one agrees with all of them or not, juxtaposed against its fiscal year 2018 accomplishments. The Securities and Exchange Commission filed and settled two enforcement actions against issuers of initial coin offerings for violating securities registration requirements. These cases represented the first time the SEC assessed fines in connection with a non-fraudulent ICO. In its enforcement actions against Carrier EQ Inc., DBA AirFox, the SEC alleged that the company issued digital tokens on the Ethereum blockchain, termed Air tokens, to raise funds to develop a, quote, new international business and ecosystem, end of quote, that would permit holders to transfer Air tokens to each other, engage in peer-to-peer lending, and to buy and sell goods and services other than mobile airtime or data, as well as to take advantage of existing company functionality. Prior to the ICO, AirFox was principally a bricks and mortar company that sold technology that allowed customers of certain prepaid mobile telecommunications operations to earn free or discounted airtime or data for reviewing advertisements on their smartphones. In its enforcement proceeding against Paragon Coin, Inc., the SEC claimed that the company initiated an ICO to raise funds to bring blockchain technology to the cannabis industry and to promote the legalization of cannabis. Digital tokens in connection with the ICO were named Paragon Coins, or PRG. Both companies promoted their ICOs as an opportunity to profit through appreciation in the price of their tokens, said the SEC. Neither AirFox's nor Paragon's blockchain-based business models were up and running at the time of their ICOs, which were marketed, noted the SEC, to the general public. Each company said they would take steps to list their tokens on secondary markets. In accepting settlements from each of the respondents, the SEC noted that each company's digital tokens were investment contracts and thus securities under applicable law. This is because purchase of the digital tokens represented an investment in a common enterprise with a reasonable expectation of profits through the entrepreneurial or managerial efforts of others. The offer of these securities to the general public required registration, said the SEC. To resolve these actions, each respondent agreed to pay a fine of $250,000, file a registration statement with the SEC, and pay back upon request any initial purchaser of digital tokens from the issuer. This payback undertaking does not appear to apply to any secondary market purchaser of a digital token. Contemporaneously with publication of its two settlement orders, the SEC issued a, quote, statement of digital asset securities issuance and trading, end of quote, by 3 SEC divisions that reviewed SEC enforcement actions against initial offers and brokers of crypto securities, investment vehicles investing in crypto securities, and secondary market facilities of crypto securities. Among other things, the division indicated that the AirFox and Paragon litigation settlements provided a path to compliance for prior issuers of unregistered or not lawfully exempt crypto securities. Well, that's it for this week's edition of Bridging the Week. As always, there's more information in each article and more articles on the article version of Bridging the Week on the website. That's www.bridgingtheweek.com. Check it out. I'm Gary DeWaal, and have a great 2 weeks. Until the next edition of Bridging the Week on December 3rd, happy Thanksgiving and ciao.